Welcome back. So the material we have is an analysis on TeraWulf, or WULF, positioning it as an infrastructure play for the AI energy crunch.
Right, it's all about their 95% zero-carbon energy access.
I thought it did a great job zeroing in on that pivot to AI hosting, using specifics like the price targets, from $15 to $26. It's a really compelling story.
It is. The whole thesis that WULF is becoming a clean energy infrastructure company, that's what justifies the massive repricing analysts are talking about. But for this to really work for a skeptical investor, I think there are three big questions.
Okay.
How insulated is that new AI revenue? How dangerous is all that debt? And, is zero carbon really a better moat than just being cheap?
Let's start with that pivot then. The analysis makes a strong case that WULF is becoming an energy company, right? It highlights that shift from volatile Bitcoin mining
To the fixed high-margin revenue you get from AI hosting. And that shift is everything. But I do wonder if it's relying too much on the promise of stability instead of the demonstrated structure of it.
I see what you mean.
So the material really needs to structurally solidify the transition from WULF as a volatile crypto miner to a stable infrastructure player to fully justify that massive repricing analysts predict.
And the weakness there is pretty clear then. It mentions the different revenue types, but it doesn't really delineate how WULF has mitigated its legacy volatility in practice today.
Exactly. And that's what scares investors. They see $1.5 billion in debts, they still see Bitcoin operations, and they immediately think one crypto crash could sink the whole AI plan.
No matter what management says their intention is.
It doesn't matter. So the suggestion is to immediately integrate the specific structural and contractual mechanisms that WULF is using. You have to show how they're building a firewall around this new HPC and AI revenue stream.
We need to see it framed not just as an operational shift, but as a formal, like a financial and legal separation.
Yes, concrete proof of separation.
Okay, so for example, that Nautilus stake sale. It was meant to fund the Lake Mariner build-out. The analysis could dig into how that transaction legally and financially separates the AI segment.
Is the AI build-out capitalized entirely on its own? Or is there still, cross-contamination on the balance sheet?
Investors need to know that wasn't just a cash injection, but a real a divorce decree between the two risk profiles.
Precisely. And what about the partners? The report mentions leasing backstops from big tech players like Google and FluidStack.
Right.
You could make this so much stronger by exploring if those are take-or-pay agreements. Do they guarantee revenue no matter what happens on the Bitcoin side?
Or are there specific covenants in there that insulate them from Bitcoin's operational decisions? If those AI contracts are fully isolated, that's the structural moat you need to show.
And it comes down to management's focus, too. We need details on how capital allocation has formally shifted. If 80% of new CapEx is legally bound to Lake Mariner Phase 3.
That shows a clean break in the risk profile, way better than just saying you intend to pivot. The money trail has to prove it.
Okay, so that structural firewall is a great start. But let's be honest, all those fixed revenue contracts, they don't mean much if WULF isn't solvent.
Which brings us to the debt, that $1.5 billion elephant in the room.
Exactly.
The report does detail the financial position, the current unprofitability, that negative $455 million net income, and of course, the massive debt load.
And it tries to handle that using the AWS spin. It suggests WULF is just spending money to build the AWS of zero-carbon compute.
It's a powerful narrative, for sure.
That's compelling, but comparing a $6.6 billion company to Amazon building AWS? It kind of limits the critical scrutiny this kind of analysis needs. So to really enhance the logical robustness here, those significant financial risks need a more balanced, a more quantitative assessment.
Instead of just framing them as, a necessary cost for growth.
That's it.
So the weakness is that the report acknowledges the debt and the cash burn, but then it mitigates it too quickly. It doesn't really quantify it against the potential downsides.
Like, what if AI demand cools off? Or what if those contracts get delayed past 2026? We have to ground the risk in hard numbers.
I agree. Relying on these, aspirational parallels to Amazon just isn't enough. The analysis has to provide concrete financial metrics, benchmarks.
Something you can objectively assess the debt against. This isn't just about listing risks. If you quantify the downside, it changes how you see the debt. It's not a liquidity crisis, it's a long-term infrastructure funding choice.
Okay, so let's get concrete. A good first step would be to identify the exact nature of that $1.5 billion in debt.
Yes. Is it secured? Secured by what? The hydro facilities or the new data centers? What are the interest rates?
And crucially, what are the short-term maturities? That's the big one. If a huge chunk is due in the next 18 months, that's a totally different risk profile than if it's long-term debt due in 2030.
Right. And building on that, we have to quantify the operational risk if the timeline slips. The whole story is about a revenue explosion by 2026.
So the suggestion is to model it out?
Yes. Detail what the cash flow metrics, like interest coverage ratios, would look like if those AI contracts don't show up on schedule. That gives the reader a clear sense of how many quarters of runway they have before things get critical.
And we can even use that legacy risk to our advantage here.
How so?
Well, propose a stress test. Compare the cash burn to current liquidity, but then model a scenario with, say, a 50% drop in the price of Bitcoin.
I like that. If you can show WULF survives the legacy downside while still funding the future upside,
Then you've just made a much stronger case that the AI build-out is truly insulated and financially resilient.
okay. So those first 2 points really bolster the financial narrative. You confirm the separation and you quantify the debt. Now let's get to the cornerstone of the whole report,
The competitive advantage.
the whole zero carbon piece.
As I see it, the argument is that WULF is so highly valued because it has immediate access to hundreds of megawatts of zero-carbon power, nuclear and hydro.
And analysts are citing that scarcity as the main reason for their upgrades. It's a great premise, right? Zero carbon compute is scarce, so WULF has a huge advantage.
But you're thinking we need to challenge that a little.
We do. We need to challenge the assumption that clean energy is the sole moat. That central claim of 95% zero carbon power, the core of the value proposition, it needs to be contextualized with a detailed competitive landscape to show its true, unique defensibility.
So the weakness is that the analysis just assumes that the power source, Lake Mariner and Nautilus, is inherently superior. It doesn't really explore the trade-offs compared to rivals like CoreWeave or even Mara.
Exactly. It assumes clean equals cheaper and better, but it doesn't prove it, especially not relative to cheaper, maybe subsidized, brown power alternatives.
You have to ask, is there a risk that by focusing only on the source of the energy, you overlook the hard economics?
That's the core question. So the suggestion has to be to quantify the cost advantages or the regulatory security that this zero carbon status provides. You have to ask, why should an AI company care about clean power if a competitor can offer them cheaper compute?
Let's start with the cost. The main reason clean energy is a moat is if it means a lower long-term fixed cost.
So the report needs to include an analysis of the cost per kilowatt hour WULF pays versus what competitors pay for grid power, even if it's higher carbon.
Right. If WULF's PPA locks in power at, say, 3 cents a kilowatt hour for the next decade, while a rival is paying 5 cents today,
that long-term fixed cost difference is the moat. That's the quantifiable advantage you have to highlight, not just the word clean.
that level of detail makes an analysis truly robust. And it's not just cost, it's efficiency too. We should be comparing WULF's PUE, power usage effectiveness, against the industry benchmarks for AI data centers.
A very good point. Just because the power coming in is clean doesn't mean the facility is run efficiently. If their PUE is 1.2, but CoreWeave is at 1.09, that clean energy advantage gets diluted.
So you have to frame the question, are they a true clean infrastructure leader, or just a data center with a clean power source that might have some legacy operational baggage compared to newer rivals?
It's critical. And there's the regulatory trade-off, too. The competitor might look at WULF's huge fixed infrastructure like Lake Mariner and decide their strategy is to build smaller, more flexible centers wherever power is cheapest at that moment.
Exactly. It's a great counter-argument to explore. I'd suggest looking into the specific regulatory risks of maintaining the licenses for Lake Mariner and Nautilus. Contrast that long-term commitment, the cost of keeping those licenses for decades, with the flexibility of smaller gas-powered centers. Does the zero-carbon badge come with unforeseen regulatory headaches that actually limit their ability to expand quickly? Or is it a real future-proof shield?
And investigating that question shows intellectual honesty. It makes the final positive conclusion so much stronger.
Okay, we have covered a lot of ground here, all aimed at maximizing the impact and the logical robustness of this analysis. So to summarize the actionable takeaways.
First, you have to structurally solidify that AI pivot. Show the firewall. Detail how the Nautilus sale and the structure of the AI contracts legally separate that new revenue from any crypto volatility.
Second, bring real rigor to the financials. Provide a quantitative analysis of that $1.5 billion debt. That means maturities, interest coverage ratios, and a stress test for the cash flow against potential delays.
And third, truly contextualize the zero carbon advantage. You have to go beyond just saying the energy is clean. Quantify the moat by comparing cost per kilowatt hour, operational efficiency through PUE, and exploring that whole regulatory security versus overhead trade-off.
This is really strong material at its core.